Well, hello everyone, and welcome back to our overviews of MBA 601 Financial Management. This is our overview of Unit 5, Managing Capital. If you haven't seen any other videos in this series, obviously go back and check them out. And of course, this is all a part of Saylor Academy's course, so check the link down below and sign up. Um, if you have any questions as we're going along, feel free to leave them in the chat. And of course, if you're watching this later, because obviously everyone can't join us live, put a question you have down in the comment section, and we'll get to it. But I will just hand it right now over to Dr. Lou Pearsall to get us going, and I'll get out of the way.
Thanks, Michael, and welcome back to anybody that's listened to our previous presentations on financial management. Before I get started, let me just note that there have been a couple of comments registered about having more examples of some of the financial concepts we're talking about. It's a good point. However, remember that this is an overview. We're trying to present a bunch of very complex topics in a short period of time. Yes, there are lots more actual examples to work through in the course itself. And if you're really interested in some of these topics, there's lots of information that's available online to dig into them a bit more than we can do in the short amount of time we have for our presentation. So having said that, let me start out by just reminding everybody about our course objectives. And for Unit 5, we're specifically focusing on explaining the steps of developing a capital budget. Now, remember that capital budget is something that companies typically do on an annual basis because it relates to planning expenditures of large sums of money, typically for plant and equipment. So it takes amount of time to think through, to analyze, and more importantly, to ensure that the capital is available to implement those programs. We want to recognize the importance of free cash flow as a measure of performance. Now, this is a new topic, and we're going to touch base on this today, but especially as a former CEO of a company, I'll tell you, it's a very critical measure of the decisions that are being made. And we'll talk a little bit about exactly what free cash flow is, not to be confused with cash flow. And finally, the ability to actually calculate the cost of debt and equity. We need to know those because if we are going to make an investment, we're looking for a return. That return has to at least cover the cost of the investment, which includes covering the cost of the debt and the cost of the equity. This is Unit 5 out of the 7 units in this MBA course, and we are going to talk specifically about managing capital. One of my favorite topics and one of key importance to anybody responsible for managing or running a business. Some of the objectives in this unit will be to, again, review the cost of capital and what the implication of that cost is when you consider potential returns on making an investment. Determining the cash flow of a project. Remember, we are making investments. Why? Because we're looking to generate additional revenue. And so we want to know what kind of cash will that generate for the firm. We'll talk about the importance of free cash flow. And we're going to go a little bit more depth into the idea of calculating the firm's cost of capital. So I'm going to introduce a couple of new concepts. So hang on and we'll dig into that in just a bit. Now, some of the topics that I will touch base on in today's presentation is, again, the capital structure. We'll talk more about the cost of capital, the weighted average cost of capital, or WACC. What exactly is the optimal capital structure? I mean, it's not really one of luck. We actually can control to some extent, what our cost of capital is by how we set up the capital structure in the firm. We'll talk about cash flow and specifically mention some of the implications of free cash flow. Now, again, before I go too much farther into this, let me just take a second and see if so far there are any questions on material we've covered before or before I get started.
I'm not seeing any questions in the chat right now. But of course, if anyone has any questions, as we always say, you can leave them in the chat, or if you're watching later, feel free to leave them in the comment section below. But I'll let you keep going, and if anyone has any questions, I'll jump in and I'll be your arbiter of questions.
Thank you, sir. So let's get started. And again, cash flow. The cash flow not terribly complicated, but we are talking about cash, right? And so we want to know, based on what we're doing. Let's look at it this way: in the day-to-day operations of the business, we have cash that comes into the business in forms of revenue and payments for goods and services. We have cash that goes out as you're paying for materials or paying for payroll and rent and the like. The difference between those two is cash flow, which can be either negative or positive. Obviously, we're hoping for positive cash flow, but recognizing the dynamics of business at any given point in time, there are times when that cash flow can be negative. We understand that, which is why one of the things management does is we prepare a cash budget. And so we actually sit down and we forecast, we anticipate what the cash flow is going to be on a month to month and quarter to quarter basis. And so if you have a seasonal product, there may be a point of time where for a couple months in the year, you have a negative cash flow while you're waiting for a season to start. That's not necessarily a bad thing if you know it, you've budgeted for it, and you prepare for it. And that's why businesses may have lines of credit with their local lenders, so that when I do have those periods of negative cash flow, I have a method of having cash available to keep the business operating. Okay, so that's cash flow. But I want to take a step further and discuss the idea of free cash flow. Now, free cash flow is a very important and I believe a very critical measure for a business. So first, what is free cash flow? Well, if you were to take the cash that comes into a business, and for example, from revenue, and you account for all the operating expenses. Now, note here I'm saying operating expenses. So not necessarily all the expenses in the business, but those specifically related to day-to-day operations. I mean, a company may have some expenses because they're doing some outside investments and something not related to the company. We're not going to count those. We want the operating expenses tied to this business, the taxes that have been paid, and if there were any outstanding positive net present value projects. Now remember what those are. A positive net present value project is one that if the firm invests in it, it will have a return that is great enough to cover the cost of the investment and have a positive impact on wealth to shareholders. So all operating expenses have been paid, you've paid taxes, and you've made any investments in positive NPV projects that are on the table. If there is cash left, that is free cash flow. Now, why is it free? It's free because it's not required to operate the business. You've covered all of that in the expenses and the taxes and the investments you've made. So what is free cash for? Free cash is for, the company may make a determination to pay dividends. Sometimes firms, if they have an exceptionally good return on free cash flow, can make a one-time dividend payment, give back to investors some of the money they've paid in. You could use it to pay down debt early to reduce the cost of debt maintenance and interest payments. But here's the key. In my mind and in my experience, the free cash flow is a report card on the decisions that I've made in running the business. If what I've been doing has resulted in generating revenue of a sufficient amount that we've covered all the operating expenses, paid all of our taxes, invested in available projects for us in terms of plant equipment for expansion and growth, and there's money left over, then those decisions have been pretty good. And the more free cash flow that's generated, in my mind and in the mind of your investors, the better job we're doing. And so it is a great reflection of exactly what the firm is doing, and more importantly, the kind of impact they're having on creating real value in the eyes of their investors. Okay, so that's a key. Now, when you think about all that, maximizing free cash flow by making appropriate management decisions, it obviously turns our attention to the idea of, yes, capital management. Capital management is just that, it's managing all the capital that the firm has. And think about this process. If you're a sole proprietor, you started a company, you've invested your money to start a business. You're making decisions on that money to invest in plant equipment or to support the services that you're going to offer to the market. Or you're a public company and you're receiving money from shareholders as stock is being purchased. There's cash coming in, and you have to manage that cash. To manage it to do what? To increase the value of the firm, do it profitably, create an improvement in profit year over year, and yes, generate free cash flow. Now, the whole process can be complicated. It is. And the larger the firm, the more time it takes, the more analysis is required. I can tell you that as a former president and CEO of a company, a goodly amount of my time was spent in issues dealing with capital management. It's a critical part of the business. But in my world, the definition of capital management is simply this: it's the process of managing my firm's money. Manage the money. That's one of your key responsibilities in the business. Now, as you run that business, remember that they're on a day-to-day, month-to-month, quarter-to-quarter basis. There are a lot of demands on cash. We have short-term demands. There's payroll, cost of materials, rent, and the like. All those things necessary to keep the business going day to day, week to week. So we have to manage that. What does that mean? Well, take a basic one: payroll. Based on the number of people that you have in the organization, there is an implication for the amount of the payroll and the expenses associated with payroll and the benefits for employees, the training that might be required. That is a manageable cost, meaning you make decisions on how large or how small the payroll can be. Now, it's not as simple as saying, well, keep payroll small to minimize cash. What if that has a negative impact on quality, production, customer service? So you're constantly weighing alternatives as you manage those short-term expense items. The cost of materials. At one point in my career, I was responsible for global purchasing for a international corporation. We spent a substantial amount of time continually evaluating the cost of the materials and parts that we were buying in support of our production facilities, which were located around the world. Our purchasing budget was in the tens of millions of dollars a year. A 0.5% savings in costs could have a huge impact on the overall success of the business. So that's managing cash, okay, on a day-to-day basis. Cash coming in. One of the things that I did early on in my career, I was keenly interested on a monthly basis on getting a report of accounts receivables. You've sold your products and your services, and invoices have been sent to customers, and you're waiting to receive your money. And so we would look at a receivable report to see what amount of money was due and current, how much of that was past due, 10 days past due the due date, 30 days past due and so that we could take actions. For example, if in fact you noticed that the past due on accounts receivable was increasing, what are you going to do? I mean, there's certainly opportunities to increase your collection, but one thing to consider is avoiding those potential hazards. And should we be reviewing our credit policy? Is the credit policy perhaps too loose? Do we need to tighten it up, make it a tad stricter? So that's what I mean by actually getting involved in managing capital. And on the long term, we're talking about larger sums of money for capital investments in plant and equipment, launching new product lines, expansion of facilities. So you've got all of these things that you're working at. In fact, as you sit there in that chair, there are a lot of competing interests for the dollars that you have. There can be lots of good things to spend money on. The question is, no business, at least no business that I've ever been involved in the last number of decades, has ever had more money than we could possibly invest. I will tell you that there have been times in my career when I wished that I had substantially more money to invest, but most times you don't have that luxury. And so it's necessary for you to make decisions on where you will spend the capital that you have. You have 10 projects before you. All are positive, all can have a positive impact on the business, but you can afford to invest in four. Which four of those projects will you and make your investment in? And obviously, as we talked in prior presentations, one of the driving points here is you'll make the investment where you get the opportunity for the greatest return. Let's put our money where we'll get the most money back for the firm and for our shareholders. Now, having said that, where do we start? How does this process get started? And we've touched briefly on the fact that one of the major things that management has to do is to determine the capital that's needed to support the business and to be able to make some investments in key projects and initiatives, and to make a determination on where that capital will come from. Now, generally speaking, there's two buckets of funds that make up the capital available to the firm. One comes from debt, money that we get from a lender. We borrow X number of dollars to have cash available to invest. And the second is equity, the money that's generated by the business and by the investors acquiring stock in the firm. So we have this debt and equity. The decision facing management, and it is an important decision, is exactly how much of each you plan on using to develop the firm's capital plan. Assuming you had no restrictions and you had access to all of the debt that you required and you had access to a pool of equity, how much of each are you going to use to build the capital plan? Now, before I go further, let me back up 1 second and remind everybody that the capital plan is actually a plan. We've thought about this. We've done considerable analysis. We've evaluated investment opportunities. There is a ton of data sitting on the table in front of us. And as a result of that, we have estimated when we put together this year's strategic plan and the budgets, exactly how much capital we wanted in the capital plan. All right, so it's not by accident. We have a number. Now the decision before the board is how much debt and how much equity will we use to meet the requirements of that capital plan. Now, we said debt it's using other people's money. We go to our local lender and we borrow short-term or long-term loan. Debt is called leverage. Why? Because we're leveraging other people's money to make an investment and generate a return. Now, note that debt financing usually costs less than equity financing. And we'll talk more about why that is in a bit. Now, from an investor's point of view, from your shareholders, using debt is a good thing. It actually increases the return on equity. Very simple reason. You are earning money for shareholders using somebody else's money. You're not using theirs. So their return on equity is very good. The lower amount of equity, the greater the return on equity for your investors. Now, debt financing can come from something as simple as going to a bank and taking out a loan. Firms can also issue bonds, which is a debt instrument. A bond is selling an IOU to the public. You buy a bond, and just like a loan, that bond has a payback date, and it has interest payments that are made on some predetermined schedule. So people can invest in bonds just like they can in stock. Equity is ownership. And that's a key issue with equity. If I have shares of stock in a company, then I am part owner in that company. We talked last week about the fact that common shares, common stock gives me a voting interest in the firm. I can vote on decisions the company is making. I can vote on the board of directors. A shareholder buys stock, takes an ownership position, and that investor now also bears all the risk of that investment. If the investment doesn't work out, the shareholder has no recourse. The return of that money is not guaranteed. So you can invest $100,000 in stock, you can lose $100,000 in stock, right? So the investor bears all the risk. But with that ownership stake comes an ownership stake in all of the firm's future profits. So we look to invest in companies that have a positive track record, that are doing positive things and moving forward. Now, before we go much further, let me just summarize quickly this difference between debt and equity. And as all things in business, there's a advantage and a disadvantage to all things. And your task is to sit there, evaluate the advantages and the disadvantages, and make a determination on exactly how much risk you're willing to assume in your decision. Now, when we talk about debt, the advantage is the lenders don't get any ownership rights. So the bank doesn't become an owner in your firm. When the debt is paid, the relationship is over. There's nothing more to talk about. And typically the interest that you're paying is a tax deduction. We mentioned that earlier on in our presentations, that's called the tax shield. So I know that although I am going to pay a certain amount of interest, I will get some relief on the tax side because tax is deductible. The disadvantage to debt is that there's a payment schedule. We call that debt maintenance. And a firm has a responsibility to ensure that they are able to meet the interest payments on the debt they have. Let me go back to that whole issue of capital management. This is one of the tasks. If a firm misses interest payments, what's likely to happen? The lender could call for the debt to be paid in full, or most likely it'll result in penalties and even in an increase in the interest rate. So we have to manage that. We have to ensure that capital will be available when those interest payments are due. The more debt that the firm uses, the greater the risk of default. Default means that at some point, if a firm is carrying too much debt and they can't serve the debt and it's not turning the business around, the business could file for bankruptcy. In which case, certainly your shareholders lose everything and lenders are liable to get pennies on the dollar. And there's also a potential issue with collateral. When you're going out and securing a debt, the lender may very well be looking for collateral. Anybody who has purchased a home, if you've got a home mortgage, you know that while you're paying the bank your mortgage, which could be for 20 years or more, the bank owns the house. It's collateral for that loan to ensure that the loan is paid off. Well, in the world of business, there's collateral too. Depending on the size of the loan, a lender may request that we pledge our equipment or property or even inventory as collateral or assurance that the loan will be repaid. Now, on the equity side, the advantage is that one, equity doesn't have to be repaid. On the other hand, if you'd like to continue to grow the business and sell more stock, you certainly want to be able to generate a return for your shareholders. The advantage is that investors are looking for future returns. So if you're using money and making wise decisions and increasing the value of the firm, then you're meeting the expectations of your investors. The disadvantage, of course, is that you're giving up ownership rights. So the individual who starts a business, it becomes very successful, it starts to grow. There's an opportunity to expand even further. You open up to investors, you go on the stock market and sell stock. You are now giving up ownership rights in that business to new investors. And that obviously means that now you have participation from folks outside of your business in business decisions. All right. So a lot of things going on there. And if this is demonstrating that the concept of capital management can be a difficult task, then I think I'm making my point. It is. It's not impossible. It's difficult, requires a great deal of attention and real management. Now, the capital structure we've been talking about is going back to the simple determination that we've decided that we have to have a capital plan of X number of dollars because we know that we have investments that we have to make in new plant and equipment. The firm decides, the owner of the firm, the president and the CEO, and the financial executives decide how they will structure that capital plan. How much debt will they use and how much equity? So, for example, the firm decides to borrow $6 million from lenders. We're going to take out a $6 million long-term loan from our local bank. We're going to raise $4 million by selling shares of stock to raise the $10 million we need for our capital plan. Now, what does that mean? That means that we have a debt to equity ratio of 60 to 40%. Or our capital plan has 60% debt and 40% equity. Now, having said that, with all of that to ponder, I'll stop here for a quick break and see if that's generated any questions. Michael, I can't hear you.
Good call. I accidentally double muted myself. I was just going to say that's good because what I was going to say was I'm going to give everyone a chance here to catch up in case they're behind. You know, obviously, dense material. So we'll give everyone a minute and then we'll come back and see if we have any questions. Okay, well, I'm not seeing any questions right now, but again, if you have questions at any time, feel free to leave them in the chat, or if you're watching later, leave them in the comments section below. But let's just hand it back over to Dr. Pearsall, and we'll just keep on moving.
Okay, and you know, when it comes to questions, I recognize that there's a lot of material that we're covering in a relatively short period of time. Remember that this is an overview of a master's course. Which will take many, many hours of review and reading and studying to get through. So as there are questions, and it wouldn't be surprising if they occur to you later, again, feel free to post those questions. But let me continue and dig more into this idea of the cost of capital, because money is not free. There is a cost to it. And one of the things that the firm needs to know is at any given point in time what their cost of capital is today. And I'll tell you that we also spend a considerable amount of time looking at forecasts and trying to predict what the cost of capital will be going forward. Anybody who pays any attention at all to the economy based on how far your check is going, if you're working, and the taxes that you pay or the interest that you're earning on a savings account, this is a very fluid topic. And so Imagine sitting there with a multi-million dollar multinational business and trying to determine what you think the interest rates will be on debt 12 months from now. With all of the analysis and the research that we do, it's still only our best guess, given what we know today. So the cost of capital, again, is an important criteria. We talked a little bit of why we use the cost of capital in our analysis of projects that we're going to invest in. Remember that when we looked at investing money today for money to be received in the future, we took those future earnings and we discounted that back. We discounted it back to what is the present value. And what did we use as a discount rate? We used the cost of capital. Typically what a company will do, their weighted average cost of capital. Now, a couple things to note about that cost. One, the amount of debt increases the cost of debt. Now, this makes a good deal of sense when you think about it. The more money you borrow, the greater the risk of default. Now, who is bearing that risk? The lender. So if I go to the bank and I want to borrow $1 million, there's a certain risk that the bank assumes that I'm going to pay that $1 million back, which is why they do credit checks and review financials and the like. And they assign an interest rate. Now, that interest rate and the risk are going to be greater if that is $10 million or $100 million. So the more debt that the firm uses, the greater the risk to the lender, and that typically means that the cost of debt will increase. The cost of equity also increases as you use more debt. Now, we're going to talk about this in a bit, but I want you just to think about that for a minute. As the company uses more debt and less equity, the equity that they use, the cost of that increases. Why? For the same reason that the bank has a problem with risk. As debt increases and the risk to the firm of default increases, that means that investors, their equity, the risk on that has increased. And if you go back a few of our presentations, you remember one of Pearsall's rules. The greater the risk, the greater the expected return. So as risk increases, the expectation of return increases. So we've talked about default. And there's a couple of things when we talk about capital management. Think about this with default. If a firm is facing a problem and they recognize that there's a potential issue with covering their debt, sales are down, costs are increasing, the business might be under some financial pressures. Part of the other risk to the firm prior to actually default is think about the amount of management time that is now being consumed with dealing with these day-to-day issues, trying to ensure that there's money there to meet the payroll, to pay the suppliers, to make interest payments on the debt. The more challenging the financial situation for the business, the more challenging it is for the executive management team that's running that business. And so that's an issue. That is also part of capital management. Now, the cost of equity, it represents a cost to the firm, because the cost of equity is, what does the investor expect to get back? All right, so depending on what the investors are looking for, the expected rate of return, which we've referred to a number of times in our presentations, that is a cost of equity. It's what you expect or what you require when you invest your money. Most of us, when making an investment, have some expectation of what we think we're going to get back, or at least I hope you do. We don't invest money and hope that something comes back someday. We have some expectation of when and how much money will be returned to us based on that investment. Because as you know, and we've talked about it before, you can invest in a risk-free instrument. You could put your money in a savings account and earn 2% annual interest compounded on your money. You could invest in a treasury bill or a treasury bond and get a guaranteed interest rate and your money back in a certain period of time. a risk-free investment. So if you're going to take an investment with risk, then you're going to be looking for more money. Now, we talked about the concept of weighted average cost of capital. Matter of fact, this is the slide from Unit 3 when we put down a simple capital plan here where we were going to use 2.5 million in debt and $3 million in equity to generate the 5.5 million we needed in our capital plan. Now, the cost of debt we said would be 6.2%. That was the interest rate that the bank is going to charge us for the loan. And we put down a cost of 9% for equity, again, based on the expectations of our shareholders. The debt to equity ratio in this case is 45-55. We are using 45% debt and 55% equity, so more equity than debt. The weighted cost was simply the amount of debt times the cost of debt, which was 45% times 6.2, the cost of debt, giving us a weighted cost of 2.8. And for equity, it was 4.9, giving us a weighted average cost of capital for this capital plan of 7.7%. That's the cost of capital. Now, for those of you so interested, I've included at the bottom of this what the formula is for the weighted average cost of capital. Again, not terribly complex. Knowing the amount of debt and the cost of debt is relatively easy in the program because you know how much you're borrowing and you know what the interest rate is. One of the challenges here is really determining what is the cost of equity. So we had talked briefly about understanding the difference that investors are looking for more than the risk-free rate, all right, because they're going to assume some risk, so they're entitled to more of a return. How much return? Well, now I'm going to show you the good news. The good news is that we can actually do a reasonable job of calculating what the cost of equity is. And to do that, we're going to use what's called the capital asset pricing model. Sit back, take a deep breath, and think about this for a minute. This is really not as complicated as it may seem. The CAPM model is used to help us project the cost of equity. So if you look at this formula, R sub S is what is the rate of shareholders' equity, or what's the rate of equity? What are they looking for? The return on equity. To determine that, we're going to look at a couple things. The first thing we're going to look at is the risk-free rate. Remember that every investor, including the company, if you're sitting there with money available, has the opportunity to simply invest that in a risk-free rate. You can invest your money in treasury bonds. You'll get so much interest a quarter, and you get your money back at the end of the period. Maybe it's a 5-year bond. In 5 years, you get that money back. That's a risk-free. We know what that rate is. We can look it up on the market where you can track what a treasury bill or a treasury bond is selling for. So we know what the risk-free rate is. Now, what about the additional risk? The additional risk says we're going to do this. We're going to look at RM, which is what is the market in general returning? This is consider a portfolio of all the stocks that are available on the market. So this is a fully diversified portfolio of stocks. The overall market, which has winners and losers in it, stocks that are up and down, is generating a certain return. So let's see what the market is returning. Now, from that rate, and obviously that rate is going to be higher than the risk-free rate, right? Because there's a lot of risk in the market. So there's a higher expectation of return. Let's subtract the risk-free rate from that. That's going to give us what we call the risk premium. So now what you're looking at is the risk-free rate plus the additional rate or the risk premium because you're assuming risk. We're going to do one more thing. We're going to look at that firm, that company, or that project, and we're going to look at the beta of that firm. Now, before we get into the Greek alphabet, beta here simply means what is the risk of that particular company. Beta is a measure of how a firm is doing compared to the overall market. All right. So if you look at the marketplace, the beta for the market is 1. It's 1.0. Individual firms can have a beta that is greater than or less than that 1.0. And what does beta mean? If the marketplace has a beta of 1.0 and my company has a beta of 1.5, it means that my firm is riskier than what the overall market is doing. Now, if I'm successful, that also means my return is better than the overall market. But it doesn't indicate that there's risk. It's not as safe as the overall market. If the beta is negative, it means that the risk is less than the overall market. Now, that probably also means that the expected return is less because there's less risk. I'm going to leave beta with this. There are a lot of ways to calculate beta. If you're into charts and graphs and regression analysis and calculating means and variances, you can calculate the beta. Matter of fact, you can calculate beta for a stock with some Excel formulas. You can look on a stock page. Most brokers, when they're giving information on a company, will list the beta of the firm. So let me assume that you can get beta. What is it doing here? It's taking that market risk premium. Remember the risk-free rate minus the market risk. We're taking that. We're now going to multiply it by the beta, which, assuming the beta is greater than 1, increases that risk premium, right? The greater the risk, the greater the expectation of return. And by doing this simple, and it's simple once you have all the numbers, calculation, we can estimate what the expected rate of return is or what the cost of capital is. Now, before anybody panics, let me give you a quick example. Let's assume that the rate of return on the market is 13%. The overall market is enjoying a 13% return on investments. The risk-free rate from a treasury bond is 7%. That's the risk-free rate. And the beta for my firm is 1.2. So slightly riskier than the overall market. So given that information, can I estimate the cost of equity? Yes. Risk-free rate is 7%. We're going to look at the 13% return on the market minus that 7%, which is 6%. We're going to multiply that 6% by beta 1.2. That's the additional risk that we're going to assume. And that gives us a 7.2% market risk premium. So what's the cost of equity? It's the sum of the risk-free rate plus the market risk premium, or 14.2%. So in this case, my cost of equity is 14.2%. And what that says is it's logical when you step back and think about it for a minute. This is for the benefit of shareholders, right? They're investing money. What do they want to get back? Well, if the shareholder invested in the risk-free bond, they get a return of 7%. That's a given. By investing in your firm, they're looking for more than that. Well, how much more? The risk-free rate plus a premium based on your standing in the market with what the market is doing and any additional risk. So the average shareholder is looking for a minimum return of 14.2%. That's what you're going to use as the cost of equity. So it's not quite guesswork as we sit there and work on making a determination of our capital plan and determining what the cost of equity is. Now, one thing I said was that given this and knowing that the overall cost of capital, the weighted average cost of capital, will vary by the amount of debt and the amount of equity you use, what is the right percentage? Again, we're not going to guess at this. What we're going to do is we're going to sit down and we're going to determine what the optimum capital structure is. All right. And the optimum capital structure simply says, at what debt to equity ratio do I have the lowest weighted average cost of capital? Now, this chart is fairly simple, but I want you to think about a few things. What I've done here is we've got a basic spreadsheet that lists down amounts of debt from 10% to 70%. All right. Uh, and and alternately the amount of equity. So if I'm using 10% debt, then I'm going to use 90% equity in my capital plan. If I use 70% debt, I'm going to use 30% equity. The cost of debt. Now we can determine the cost of debt because that represents the interest that the lender is going to charge us based on the amount of money we're going to borrow. Now, note what I said was that as the amount of debt increases, what happens to the cost of debt? It also increases. Why? Because the more debt you borrow, the greater the risk to the lender, their expectation of return is greater, interest rates are higher. We're also going to allow for the fact that the cost of debt or the interest rate has that tax shield. So depending on what the firm's tax rate is, we're going to take the benefit of that tax rate to reduce the cost of debt. So if I assume that the firm is paying a tax rate that's about 30% is what they pay in taxes, then that means that the after-tax rate for interest is the interest rate times 1 minus the tax rate. In this case, that means that it's going to be 0.7%. So the actual cost will be 0.7%. So the after-tax cost of debt goes from 3.6% at 10% debt to 4.8%, 70% of debt. For those of you who are wondering why we don't have more numbers, I'm hoping you have more than enough numbers now. Now, equity, as the percent of equity, the higher the percent of equity, the lower the cost of equity. Again, why? Because as I am using less equity, what am I doing? I'm using more debt. As I use more debt, the risk increases and shareholders are looking for a greater return on the investment. So even though I'm using less equity, the cost of equity is increasing. I'm going to let that sink in for a minute. And simple concept, if the money is riskier, the investment is riskier, then the investor is expecting a greater return on investment. Now, looking at that, now I've calculated the weighted average cost of capital, just what we did a page or two ago, for each of these 10 to 90, 20 to 80 debt to equity ratios. And notice what happens. At one point, at a 40/60 debt to equity ratio, I have the lowest weighted average cost of capital. So what will my capital plan be? Assuming I have access to 40% debt and 60% equity, that's going to be my ratio, 40/60. Now, to make this even more complex, thank goodness for Excel spreadsheets. You can take this from 10%, 10.5%, to 11%, 11.5. You can make it as finite as you want, lay out all of the different costs, put together this analysis, and what you typically will find, no guarantee, but generally speaking, is in this range, in the 40 to 60% debt to equity ratio, you generally will have the lowest weighted average cost of capital. So now when we think about what is that, go back to that formula for the weighted average cost of capital. What's the cost of equity? We can determine that right here. So we've used the CAPM to determine the cost, what the shareholders are looking for as an expected return, given their opportunity to have both a risk-free investment and recognizing the premium for investing in the market. And based on the debt to equity ratio, we've been able to calculate our weighted average cost of capital, which, if you recall, is the number that we use to discount future cash flows. We use it to solve for net present value and the like. Now, next week, we're going to talk about valuation. Excuse me. I want to get into some more detail on, a lot of our discussions have been on what management is doing, the management decisions, And the idea being that you should be focused on improving the value of the firm for the benefit of ownership and shareholders. Well, let's talk about some ways that we can actually determine how effective that strategy is and what the value of the firm is. So that's what we'll talk about next week. And so at this point, I guess we'll stop and see if there's any more questions out there, Michael.
Absolutely. And if you guys have any questions, feel free to leave them in the chat or put them in the comment section below if you're watching later. But I'll vamp for a minute and I'll ask you a layman's question as a guy who used to be okay at math in college. Uh, so when we're looking at the rate of return from the market, like that's like a calculable thing that you probably like can look up, right? Like what the average market rate's doing, right? And then so what we would decide, I guess, like if you're talking constants and variables, like you could say maybe that like the market rate would be a constant because like whatever the market rate is at the time you're doing it, that would be quote unquote a constant. So are you just so we're just deciding as a firm that we want to go have our return be 1.2 and then that's what our beta is what allows us to make our full calculation because the other stuff is kind of decidable based on market factors, or am I thinking about it wrong?
No, simply put, it's the right idea. I remember that these numbers are dynamic, of course. I mean, what is the market worth? What time is it?
Right.
So as people who invest in the market, you'll look up on the exchange and you see what is my stock doing today? Is it up or down? But we know that stocks go up and down all the time. So what we generally look for is there a basic trend in the market now? It may be up a little bit, it'll be down a little bit as it is every day, but generally the market is returning a certain amount. If I know that the market is returning 10%, and I look at the performance of my stock against that, and I'm returning 11%, I'm doing better than the market. So my beta is higher. Why? Because it's riskier. The greater the expected returns, the higher the risk. If I'm doing less than the market, the beta is lower, the risk is lower. So now the key, of course, is picking those numbers. What market number do you want to use? And we spend a lot of time thinking, analyzing, and trying to come up with a reasonable. What do the investors see when they look at the market today?
Awesome. Well, thank you for my edification here. It looks like no one else had questions like I did. They must be all be smarter than me. Not hard to do, honestly. But again, if there's no more questions, again, if there's any questions, I'll vamp for a little bit. You can put them in the chat. But if you're watching later, feel free to leave them in the comment section below. Again, thank you everyone for watching. Of course, thank Dr. Pearsall for taking us through this. And as you said, we will be back here next week for Unit 6. And, well, I mean, thank you everyone for joining us. I don't have much else to say. It looks like everyone's feeling pretty good. So, again, just thank everyone for joining us. Thank you, Dr. Pearsall, for taking us through it.
Thank you, Michael.